We'll talk about sales forecasting and budgeting in this video. The analysis involves the study and assessment of various environment that affects a business. It requires determining the market potential for goods and services that firm currently is producing or probably is supposed to produce in future. Let's understand the classification of the term. There's a need to clarify some terms in order to understand the market opportunity analysis. What is the potential of the market? What are the sales potential of the market? What are the sales forecast and the sales quota thereby? So yes, the market potential, market sales forecast, and the sales quotas thereby. Let me discuss them one at a time. The market potential is an estimate of possible number of sales of a commodity, a group of commodities or services, the entire industry in a market during a stated definite period under ideal condition. The component of this definition is define the particular market at a particular specific time, refers to specific customer group and within a geographical area. What is sales potential? Sales potential refers to the portion of the market potential that a particular firm can reasonably expect to achieve, whereas market potential equals maximum possible sales for all sellers of the goods or services under ideal condition. Sales potential reflects the maximum possible sales of each individual firm. For example, the sales potential for Nokia to the cellular phone industry in Accra metropolitan area in 2006 would be approximately 5,000 units, or to be pound at an euro of 100 euros per se, as the case might be. That is the sales potential. But can we do differentiate between potential of sales and the sales forecast? The sales forecast is the estimate uh, of the unit sales for a specific future period under the sales marketing plan or program. The forecast may be for specific item merchandise or for an entire line of product. It may be for a whole market as a whole or for a portion of it. Note that only sales forecast includes specification of commodities, customer groups, geographical location, time period, but also includes specific market plan as an essential element. If the proposed plan is changed, predicted sales are expected to change. Furthermore, forecasting sales are typically less than what the company's potential has. Yeah, if you can see in your screen, you will have a graph which stated on a period of time and which has been mapped on x-axis, and the number of sales which has been mapped on the y-axis. Look what we are talking about, the actual sales of the firm which changes over a period of time. What was the forecasted sales altogether, and what is the similar industry sales altogether? So you have of the industry sale, you have a bulk of sales under your belt. Now that is what we need to understand. Note that one can speak of the firm forecast or an industry forecast. In fact, the latter is often just developed before the former is generated. Just as the company forecast presumes a specific marketing plan, industry forecast presumes a specific level of marketing effort. Like all the firms that serves this industry, as the firm's marketing plan becomes more effective, realized sales and forecasting sales should also come to the sales potential. We talk about sales quota. This is a good example. This is what we are talking in terms of overall objectives that is assigned to the marketing unit. Sale quotas are typically one of those key elements to evaluate the personal selling effort. They apply to a specific period and can be specialized in great detail. For instance, the sale of a particular item of a specific customer by salesman. Let's say a particular customers in the month of December. So, as this economic environment, what do we look into it? First and foremost, what is happening in the environment? Estimate the market potential, the sales potential, develop your forecast. And once you have developed your forecast, you probably executed it. Compare what has happened actually. If it is in agreement with your uh, forecasted sales, well and good, you are happy. But if it is not, you need to redesign the marketing program altogether. So methods of sales forecasting are basically of two types. One is the subjective method, the Delphi techniques, the sales forecast composites, jury of executive opinion, users expectations. The second is of all of objective method in numbers. This method gets its name from the fact that the initial input is the opinion of each member of the sales field. So budgeting factors that influence revenue. Sales budget is dependent on sales forecast. Your marketing plan is your requirements, your projected profit, top management perception of the importance of sales force in attainment of the corporate goal. The cost areas, what are they? They are transportation, they are salaries, they are vehicle running costs, they are commission, they are bonuses, they are entertainment costs, they are product samples, and any cost that is related to the sales administration. So yes, these are my cost areas and these needs to be budgeted for. Now, whenever you have to budget, you need to keep the budget is essentially a tool to keep everything in control. Involves spending person to agree to a particular expenditure. Monitoring must be done on a quarterly basis, if possible on a monthly basis. Budget must be subjected to review, must be flexible because the environment is very dynamic. So you need to skew your budget according to the changing environment. So how do we determine sales budget? The most popular, the common one is as follows. Percentage of sales, as an example. Let's say 10% of the total sales revenue should be involved into the sales budget, perhaps, or 15%. Executive judgment is the top management. Obviously, yes, the top management will be adequately experienced and they know the things in the trade. Probably they will take a judgment, estimation of running cost of each unit of sales thereby. The control of budget, all these must be from the bottom up to the top, approved approved and brought down again. This must be controlled effectively to achieve sales revenue. Expenditure must be monitored against revenues and budgets. There is a need to break down budget into smaller components, example, fuel, samples, entertainment. In addition, there is a need to input and understand the process of the sales force. Remember, sales force performance must be monitored at all point of time, no matter whether they are achieving all the sales goal or they are not yet to achieve all the sales goal. With this, I come to an end of this video. Thank you for watching.